Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to this pre-Christmas edition of Supernatural Stocks. I do hope that you are enjoying your holiday. Thank you for being here with me. And this week I've decided to focus on Nike. So we are switching to an offshore focus for this week. And honestly, for as long as I've been following this company, Nike's investor relations website has opened with a loud statement that says, Nike Incorporated is a growth company. Now that's easy to say, it's not so easy to deliver. One thing that has not seen growth is the share price, which has suffered a 5-year compound annual growth rate, or CAGR, of minus 5.3%. Yes, it has gone backwards. Not good. This year alone, Nike is down 26.5%, which is also not good. If you decided to just do it and you bought shares, you are probably now in the just regretted phase. There are a few reasons for this, and they mostly boil down to illusions of grandeur. Undoubtedly, Nike is a great brand, and it is instantly recognizable globally, from the real deal at your local mall to the endless, and I mean endless, knockoffs that I saw in markets in Istanbul a few months ago. They have a huge roster of athlete endorsements and a track record in sports that is unmatched. All of these things are lovely, but they do not guarantee that a middle-income earner looking to splurge on branded shoes is going to be willing to pay the premium that Nike demands over many of its competitors. In my own experience, at least, having deliberately bought a pair of Nikes last year to see how they would do, there's no obvious benefit in quality over some of the other established names. So you are very much paying for the brand here. This works in the luxury space, but it's a lot dicier in the affluent space. So if the main asset is the brand, then how strong is it really? This is where there seems to have been a disconnect from reality for Nike. Is the brand strong enough to shut out wholesalers like Foot Locker in the hope that consumers are so obsessed with the shoes that they are willing to buy directly from Nike, rather than visiting a store to see the variety on offer and compare Nike to other players in the market? Well, Nike certainly thought so, using the pandemic and the surge in e-commerce as a great excuse to substantially reduce the supply and assortment to the likes of Foot Locker. It worked for a while as the diehards then switched to Nike's app to get their sneaker fix. Over time though, as Foot Locker scrambled to fill the shelf space with brands that opted to work with Foot Locker rather than against them, things started to change. Nike has now lost ground against competitors in key areas like running shoes, where people actually want to try them on before buying them. Shock and horror. It's amazing how damaging the strategy has been for both Nike and Foot Locker actually. Over 5 years, Nike's share price is down 23% and Foot Locker is down 44%. The only winner here has actually been the consumer, who suddenly found themselves in an environment where previous partners, being Nike and Foot Locker, were now competing viciously with each other, making everything cheaper for consumers, although perhaps more irritating in terms of finding the shoes. Now you add this issue to the cocktail of supply chain disruptions and rampaging interest rates over the past couple of years, and the recipe was certainly there for underperformance at Nike, particularly given the combined impact of the pricing strategy and this arrogant distribution strategy. There is a very, very good lesson here about whether consumer brand moats are driven more by distribution power or brand power. It seems that distribution may well be more important. So where does this leave Nike today? Well, Nike has its tail between its legs, evidenced by the level of promotional sales in the business. If the brand is so strong, then why is there such a high proportion of discounted sales in their sales mix? The true test of brand strength and the pricing strategy is the extent of full price sales. This is where the big margins come from. Promotions should be there to get rid of the last bits of old stock. If promotions are a major part of the mix, then what's actually happening is that demand is poor at the full selling price and the strategy is wrong. Over time, this severely dilutes brand strength and it creates an environment where consumers simply wait for the inevitable promotions instead of buying the products at full price. It is extremely difficult to turn that mindset around. Just contrast this to the recent narrative at Lululemon, where I built a long position this year in response to share price weakness. Lululemon's Black Friday strategy is to use the shopping holiday to clear out old stock. They can do this because of the level of newness, as all these companies call it, in their product range, which means fresh stock on the shelves at the right price point, and hence it doesn't need to be discounted. They use Black Friday to unlock working capital and encourage people to buy some full price stuff at the same time as picking up older inventory at a discount. This speaks directly to the strength of the Lululemon brand. It's why I have shares in Lululemon and not Nike. I bought one dip, but not the other. So the big question here is, can new management fix Nike? Well, the new CEO at Nike is Elliot Hill. He's not new to Nike though. In fact, he was with the company for 32 years before he retired in 2020. He's now been back for 2 months with a mandate to fix the strategic missteps of previous management. In the latest earnings call, he shared his focus areas. Interestingly, one of the comments he made is that Nike has lost its obsession with sport. Now, over 3 decades with the company, he would understand that that really is the DNA there. They will lead with sport going forwards, which suggests that the product range might be tweaked away from some of the more lifestyle-oriented stuff. Certainly, the storytelling behind the brand will go more towards sport. And that is probably not a bad move because it plays to the key strength of athlete endorsements. That is Nike's moat. The bigger shift is a recognition that focusing on Nike Digital has hurt the business. Going forwards, they will give wholesale a real chance as well, which means they will go where the consumers are going instead of trying to force consumers to shop online. That is quite bullish for Foot Locker actually, and other businesses like Dick's Sporting Goods. So the smartest play for a Nike recovery may well be one or both of those retailers as well. It's worth a look. But most of all, they need to regain lost momentum in full price sales. Nike's digital platforms are running at a 50-50 split of full price versus promotional sales. This is unacceptable for a business that is supposedly brand driven. With revenue down 9% on a constant currency basis for this quarter, there is a lot of work to do. Gross margins fell 100 basis points to 43.6%, a victim of promotional sales. For reference, Lululemon's gross margin is 57%, and that is what a premium brand should look like. If ever there was evidence of how Nike lost its way, it's the lack of performance in a year that saw the Olympic Games take place, the ultimate celebration of human athleticism. Nike's ex-management team was not deserving of any medals, that's for sure, but Hill does seem to be off to the right start with his narrative. However, this is definitely a long-distance event and not a 100-meter sprint. Nike is trading on a price-earnings multiple of 22 times. And there are a bunch of JSE companies trading at similar levels. Just listen to last week's show about PE multiples and how you get this over 20 club on the JSE of high-quality companies. You can now buy Nike on the same multiple as that. If Hill can inject some love back into Nike, this could be one to watch in 2025. For now, it's on my watch list, as is Foot Locker, by the way. I'm tempted to invest in both, but I would like to see some evidence of the slide in the share prices stopping and those share prices starting to move higher before I pull the trigger, especially with a hawkish Fed running around. Cheap can always get cheaper, and on some of these names, it's often better to just wait for a sign that the momentum has turned. A nice trick to learn from traders. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.